Imagine watching the Bitcoin price chart drop the way it has this month. Not just a wobble, not a blip, but a clear, steady slide that takes the world's most famous cryptocurrency from near all-time highs into a prolonged downturn. It's not the first time Bitcoin has shifted dramatically, but this particular drop is meaningful because it's not happening in isolation. Bitcoin's recent pullback is the product of liquidations, macroeconomic pressure, shifting investor sentiment, institutional outflows, and a broader rotation out of speculative assets and into safer stores of value. Early in 2026, Bitcoin's price slid to levels not seen in more than 2 months, dipping below significant psychological supports like $80 to $1,000 as traders digested a perfect storm of market headwinds. On one front, speculation over leadership changes at the U.S. Federal Reserve sparked fears of tighter monetary policy and reduced liquidity conditions that typically spell trouble for high-volatility assets like Bitcoin. At the same time, other assets like gold and silver extended their rally, drawing capital away from crypto as investors sought traditional safe havens in a time of heightened macro risk. But to see why this drop is so structurally significant, you need to understand that Bitcoin is no longer a fringe asset where only hobbyists trade. It has evolved into a key barometer for risk appetite in global financial markets. When traders suddenly become cautious, Bitcoin often feels the impact before most other risk-oriented instruments. That's partly because Bitcoin lacks intrinsic yield, and when conditions favor assets that do pay you for holding them, like bonds or cash equivalents, Bitcoin becomes less attractive. One of the most powerful forces driving the recent drop isn't macro policy alone, but liquidation cascades. In highly leveraged markets, traders borrow funds to amplify their positions. When prices fall and those leveraged bets go underwater, exchanges automatically liquidate those positions to cover losses. This creates a self-reinforcing loop where selling begets more selling, pushing prices down faster than ordinary supply and demand would. In January alone, hundreds of millions of dollars in Bitcoin long positions were wiped out through forced liquidations, driving further downward momentum. That effect is amplified when leverage levels in the market are high, as recent data shows. When Bitcoin's price breached key psychological supports, programmatic stop losses and margin calls triggered waves of automated selling. And because cryptocurrency markets tend to be less liquid than traditional markets, even a relatively modest swell in selling pressure can dramatically swing prices. Investor psychology has also shifted. Risk-off sentiments are now consistent across multiple asset classes, not just crypto. When tech stocks sell off, capital flows out of correlated risk assets, including Bitcoin. That's exactly what happened as major tech names like Microsoft weighed on markets, with disappointing earnings indirectly pressuring cryptocurrencies along the way. Another key driver is the outflow from institutional Bitcoin investment vehicles, particularly U.S. spot Bitcoin ETFs. These funds have been a major source of demand, drawing institutional capital into the market. But in recent weeks, investors have pulled billions out of these products, signaling that institutional appetite has cooled. When large institutional holders exit, selling pressure rises and price discovery shifts downward. Bitcoin miners themselves have contributed to downward momentum. Mining revenue is directly tied to Bitcoin's price, and as prices fall, less efficient miners are pushed to sell holdings to cover operational costs such as electricity and hardware maintenance. Increased miner sell-offs increase market supply, placing additional pressure on price. Macro conditions are also playing a stealth but significant role. Despite expectations of rate cuts, central bank policy remains more complex and uncertain than many traders anticipated. Mixed signals from the Federal Reserve about future monetary easing have kept liquidity conditions tighter for risk assets, reinforcing caution among asset allocators. A stronger U.S. dollar, itself a function of these monetary conditions, makes non-yielding assets like Bitcoin less attractive relative to cash and traditional fixed income, further weakening demand. Global geopolitical uncertainty has also nudged capital toward traditional havens. When risk sentiment deteriorates, investors often rotate into assets seen as stores of value or hedges against instability, such as gold. Bitcoin's failure to behave as a safe haven in these moments has been notable. Instead of rising during volatility, it has often fallen, which is reinforcing its perception as a risk asset rather than a true store of value. Additionally, technical breakdowns in key support levels feed directly into psychology-driven market moves. When Bitcoin fails to hold certain thresholds, more traders assume a downtrend is underway and adjust positions accordingly. Breaching these technical barriers doesn't just trigger automated trading systems, it changes sentiment, encouraging holders to sell before further declines. The whole phenomenon reflects how Bitcoin's market structure has matured. It's no longer an isolated bubble trading on hype alone. It has become deeply integrated with broader capital markets, meaning the forces that move stocks, risk assets, and liquidity flows now move Bitcoin too. This makes Bitcoin more sensitive to macroeconomic realities like inflation expectations, interest rates, and institutional appetite. But what many observers miss is that volatility isn't a sign of failure. It's a defining feature of Bitcoin's economic role. Price corrections and deep pullbacks have occurred throughout its history, often after long rallies. These corrections act as a kind of stress test, flushing out weak positions and speculative excess. Paradoxically, this can strengthen the asset's foundation for future trends. Some analysts argue that these downturns help create healthier price structures by establishing stronger long-term support levels. What's different this time is the scale and context. Bitcoin's recent drop isn't just a technical correction after a parabolic rally. It's occurring as capital reallocates globally, as macro policy creates higher hurdle rates for leveraged assets, and as institutional trading behavior becomes more visible. In a maturing market, prices reflect not just speculative sentiment, but real capital flows responding to interest rate expectations, liquidity, and regulatory posture. But volatility cuts both ways. While short-term declines feel painful, they can also create opportunities. Lower prices often draw in long-term strategic buyers, including institutional holders who prefer accumulation during pullbacks rather than chasing rallies. Some proponents argue that periods of price weakness can build stronger foundations for long-term growth, even if they trigger fear and capitulation in the short term. Then there's the broader cycle narrative. Bitcoin has historically operated in multi-year cycles tied to halving events and broader market sentiment. Corrections are not anomalies. They are part of a rhythm that is repeated through multiple cycles. Understanding this cycle perspective helps contextualize the drop not as the end of Bitcoin's story, but as part of its evolving market structure. In economic terms, Bitcoin's decline is not a failure of the asset itself, but a reflection of how risk, liquidity, leverage, and macro policy interact in a connected financial ecosystem. Bitcoin sits at the intersection of finance and technology, and its price reflects both the speculative impulses of traders and the structural realities of global capital flows. The recent pullback serves as a reminder that Bitcoin, while unique, is not disconnected from the broader economy. Its price responds to the same signals that move stocks, bonds, currencies, and commodities: interest rates, liquidity, uncertainty, institutional behavior, and investor psychology. Ultimately, whether this drop signals a deeper downturn or a healthy reset depends on how markets interpret value relative to risk. But one thing is clear: Bitcoin's price isn't dropping because it failed. It's dropping because the global economic environment is repricing risk assets, reshuffling capital, and forcing markets to reconcile volatile instruments with macroeconomic realities. And in that dynamic landscape, Bitcoin's role and price will continue to reflect not just crypto sentiment, but the broader interplay of global finance in motion.